Some big changes to mortgage costs were just announced. In a single moment, the fees for a vast majority of new mortgages in the U.S. have changed. In some cases, the changes are drastic, both for better and for worse. Let's break it down. So what do you mean by fees and costs? All right, this refers to loan level pricing adjustments, LLPAs. Now, you guys can kind of read this part. I'm just going to break down what LLPAs in my words instead of what the article is saying, right? This is basically fees that Fannie Mae and Freddie Mac charges lenders to do loans, right? Based off of numerous different things, right? It could be credit score, it could be loan to value, it can be, those couple things. If it's a purchase, it's a refinance. If it's an investment property,
Got it.
if it's a primary residence, if it's a multifamily, there's different pricing adjustments
So newbie investor here. So the lender will then pass those fees on.
to the consumer, right?
Okay.
So, and this article is really good. That's why
Okay.
I said let's show them the article, because it breaks down a chart and kind of shows you like a matrix, right? So these LLPAs, guys, is what the lenders, what the Fannie Mae and Freddie Mac are passing off to the lenders, and is built into your interest rate. So if you have, let's just say, for example, a 680 credit score, you're buying a 3-family primary residence, and you're borrowing 80% financing, on the back end fees, that might be 3.5%, 4% on the back end. So that will in turn transition to what interest rate that the lender is going to offer you. Now remember, that's just what Fannie Mae and Freddie Mac is going to make. Now the lender has to make their money on top of that as well. So if the lender needs to make 3-4% on top of that, it might be built in 8 points into that interest rate, right? So because the lenders are not going to
Just do it for nothing.
no, we're not for profit, because if you don't understand, see, most people when you shop in loans, they think, oh, this bank can get you lower, this, that, and third. But people don't really understand these LLPAs are really what's setting the price off. You know what I'm saying? From the jump street, comparing like your whole profile to somebody else's profile. That's why when people say, yo, my friend went to this bank and they got this, well, your profile is different.
Yeah, everybody's different. I think people should know that now, right?
It's completely different. So that's kind of what LLPAs are. Is basically the fees that Fannie Mae and Freddie Mac are charging the lenders for that particular borrower for their loan scenario, right? And it's a whole matrix and everything like that too, right?
Okay.
So, and again, you guys can go read this article yourself and kind of read this, but I just want to read some couple key points, right? So it says, what lenders and loans does this apply to, right? So any loan guaranteed by one of the agencies, regardless of the lender. This is most of the loans in the U.S. Example of the loans that wouldn't be affected would be FHA and VA, as well as some jumbo loans and specialty products like non-QM loans, right?
Okay.
Are not impacted by these changes. These loans are not guaranteed by Fannie Mae and Freddie Mac. So basically, making a long story short, any conventional mortgages
It's going to be impacted.
is going to be impacted. Not FHA, not VA, not non-QM loans, not portfolio investment type of loans. These loans are not impacted by these changes that the government, the FHFA, is making. Only for loans that are Fannie Mae or Freddie Mac. Doesn't matter if you're doing a purchase, refinance, cash out refinance, buying investment property, second home or investment property. If it goes to Fannie and Freddie, these changes are going to impact you.
Now, do we know what kind of kicked off these changes, or is it just woke up?
We'll talk about that in a
Okay,
second.
because I want to know.
Save that question, right? So, when does this take effect? This applies to loans that are guaranteed by the agency starting May 1st, 2023. That means many lenders will begin to implement the changes in March and April. What has changed in a nutshell? The effective penalty for having a credit score under 680 is now smaller than what it was. It still costs more to have a lower credit score. For instance, if you have a score of 659 and are borrowing 75% of the home's value, you'll pay a fee equal to 1.5% of the loan balance, whereas you pay no fee if you have had a credit score of 780 plus. But before these changes, you would have to pay a whopping 2.75% fee. So think about this, right? And it says on a hypothetical $300,000 loan, the difference is about $37.50 in closing costs, right? So what they're basically saying, to break this down for you guys, how it is right now, if you had that 659 credit score, you're paying 2.75 on the back end for the scenario that they broke down. 659 credit score, obviously this is a single family they're referencing, and you're putting down 25%, right? Now, it got cheaper for the person who had that 659 credit score starting probably May, April. So someone with a lower credit score, it actually got a little bit cheaper by 1.25%. 1.25% on the back end, right?
Right.
On the back end. Now, everywhere else in the spectrum, things get worse. Borrowers with a higher credit score will generally be paying a bit more than they were under the previous structure. The following chart shows the differences. Green and yellow cells show where things have become more affordable than what they were. Orange and red cells are more expensive. All values refer to a percentage on the loan balance charged as an upfront fee. This doesn't necessarily come out of your pocket upfront, as lenders can offer a higher interest rate in some cases to pay these costs for you. But the costs are still there and still technically being paid by you over the life of the loan in the form of interest.
Okay.
All right? So now, you see the chart? Tooks, move the chart up some so they can see it, right? So this chart right here, again, it said in the article where it's orange and red, it gets more expensive. So what you guys are looking at, right, is basically like a matrix, right? This is what
That's what it feels like. Yes.
no, but this is on my end. This is a LLPA matrix.
Okay.
Right? So you see on the left-hand side, it has credit scores lower than 639, then it has 640 to 659, 660 to 679. So that's the credit score buckets. One of the most important changes they made prior to this change that's happening May 1st, 740 was the highest tier bucket. So any credit score above 740 was treated the same. Now you see they added 2 more levels, right? 740 to 759 and 760 to 3 more buckets.
Yeah.
They added the 740 to 759, 760 to 779, and then 780 and higher,
Yeah.
right? So they added a couple more tiers, whereas now the structure is 740 plus, everything is treated the same up until 850. Now they're making it, well, you're not A1. 740 plus in my world is A paper credit, right? Because you don't have no LLP, you have less LLPAs. Now in this new structure, now on the top row, where you see 30%, 30 to 60%, 60 to 70%, y'all see that?
Yeah. Break that down.
Right? That's your loan to value bucket,
Okay.
right?
Okay.
So I'm teaching y'all how to read a matrix
I'm learning.
too at
I'm
the
learning.
same time.
Right. I'm learning.
This is how us loan officers, this is what we look at, right? Well, everything's technology now, so you just punch it in the computer and it spits out something. But old school folks like me, I like to look at the matrices to make sure I do the numbers manually to make sure that the pricing that I'm seeing is accurate, because sometimes computers make mistakes. But I'm giving y'all some real lesson right here. So on the top, that's your LTV bucket. So when you have a credit score, so let's just say you go to a 720 to 739 credit.
Okay.
And let's just say you're putting down, let's just say you're putting down 15 to 10%. So if you go 720 to 739, and now you're at 85 to 90 LTV, you see it's 0.5%, right? You see it's negative now. It's more expensive now.
Okay.
You see what I'm saying?
Yeah.
But now you see if you borrowing more money, you see if you do a 95% LTV.
It goes up.
No, it's going lower.
No, I mean to 0.25, right?
Exactly.
Got it. Okay.
Because
Okay.
remember, orange and red cells mean more expensive.
Got it. Okay.
Green means cheaper, right? So you see you getting penalized if you're putting more money down, even with a higher credit score.
That makes no sense.
It's stupid as shit.
Okay.
You should be rewarded because you're putting more money down,
Right.
essentially.
Right.
But in this format right here, it's going to cost you more because you're putting more money down. So it's actually probably more advantageous for you for it not to.
It's like if you have the money, just hold on to it.
Yeah. So that's just basically like an LTV matrix. I just wanted to give you that quick example. Now, there's some other changes that aren't so easily translated in this heat map. The most notable is a new charge for your debt to income ratio, which, ladies and gentlemen, your debt to income ratio meant nothing towards your pricing before and did nothing to your interest rate. So if you had a high debt to income ratio or low debt to income ratio, you wasn't penalized. As long as you qualified into the debt to income ratio parameters, you were all good.
You could get the loan, but
Cool, you qualify. You meet the
right.
DTI. Now they're penalizing you if you at a certain debt to income ratio. Now you get a penalty. So it says it in here. There's a new charge for DTI. This will be controversial in many scenarios, as income calculations can be somewhat subjective and debt calculations can be legitimately tweaked with some advanced planning or debt consolidation. Nonetheless, every loan guaranteed by the agency has a DTI attached to it. So if yours is over 40% and you're borrowing more than 60% of your home value, you'll be paying more, right? So if you have, most borrowers are not putting 40% down, right?
Those facts.
They're putting 5 to probably 20% down. And let's just say if your debt to income ratio is 43%, you might get a 1/4% hit on the back end of your pricing, which can translate to probably an eighth of a point higher, a half a point. A half a point hit can probably be a 1/4% higher in interest rate. You know what I'm saying? So now your DTI. So now it's going to be even more important for folks
To lower their debt.
to lower their DTI. So now if you're running it up and you got all types of personal credit cards, car loans, and all this other shit, and now you got a 45%, 47% back end, it could get more expensive for you for interest rate because now they're looking at you as more of a risk.
Yeah.
So now they're hitting you with this risk-based pricing.
I have a stupid question.
There's nothing stupid
Nothing
right
stupid.
now.
You're right. Nothing stupid. You know what this reminds me of? It reminds me of like PMI for FHA loans in a sense, right? Like, when you're kind of risky, they charge you because it's like, how do they know they could actually trust you?
Well, it's PMI in general then.
Right. In a
Because if
sense.
you put down less than 20% on conventional, you still have PMI.
So now, yeah, exactly. So you have PMI and you're getting charged for this like whole DTI,
Yeah,
which
so-
is crazy.
well,
I
for
understand.
but you're getting charged for everything now.
Right.
Right. So even if you're having a 740 credit score, you're paying a little bit more expensive fee. If you have a 760 credit score, you're paying a little bit more expensive fee. If you have lower credit scores, you're paying a little bit more expensive fee.
Well,
right?
why can't you get rewarded for doing the right thing and having a better credit score? No, like that.
You would think that, but in this world where there's risk to, no matter what, you have a looming recession, people will get laid off, people stop paying their credit, their mortgage, right? It's just normal. So what they're doing is basically trying to continue to run it up because there was record-breaking years over the past couple years in our industry because of home prices. So you got to think of the billions and billions of dollars that was made. Now that volume's going down, that means less money. So how do we make our money back off the volume that's coming? Fees. And lenders, what do you think they're going to do? You think they're going to eat the fees? No. They're going to pass it off to the consumer, right? So look, there are a few other examples of changes. There are new credit score bands of 760 plus and 780 plus, which I just explained. There's a more differentiation between high balance versus non-high balance ARMs, but we don't have to worry about that because most of y'all are probably not doing ARMs. There's several changes to 2 to 4 unit properties on the LLPAs, which this article doesn't really break that down, but I got to read through all of that to kind of break that down on a different video. There's a new generic LLPA for subordinate financing, a second loan on HELOC, whereas the previous LLPAs were more granular depending on the LTV of first loans versus subordinate loans. And there's a big increase in fees for many cash out refinance loans.